Most people conform and follow the crowd. Some want to be different. Some think that they're different. But only a few have the courage to be different. Welcome to Microcap Explosions, where returns can be explosive. The only question left is whether you have the courage to be different. Welcome to Classic Value Investors. My name is Mariusz Konieczny, and today with me I have Hugo, the Stoop from Euronav. Hugo, thank you very much for joining me.
Thank you, Marius, for inviting us.
Hugo, so when we look at the space, the oil tanker space, I would say it's maybe an understatement to say that the sector is out of favor right now. Yet, when we look at this space alone, Euronav is, I would say, the darling or the most favorite, if I can say favorite, out of the oil tanker stocks, because you guys are doing like almost everything perfectly in terms of what investors could want. You're buying back shares, you're paying dividends, you don't have a lot of leverage. I mean, can you kind of talk about this? How did you achieve this? This status that you're like the favorite oil tanker stock out there?
Well, thank you very much for the compliment, and I'm not sure that we do everything perfectly as you put it, but we're certainly trying. I think that we've been, most of the management team that is driving this business has been here for better part of 10 years or more. And we've always applied the same recipe. The recipe is to have a high degree of discipline, to be very transparent, to tell the market and the investors what we're going to do and then execute on it. And I think that the market likes that. No surprise, high degree of corporate governance, high degree of transparency. And then indeed, on the capital allocation side, because that is mostly of interest to our investors, is to tell them that we're going to allocate, roughly speaking, 80% of our profits to return to shareholders, and that can be in two form, dividends and or buyback. And we're trying to also be disciplined around it. So when the share price is trading at a discount or a discount to what we feel is the intrinsic value, then we do a bit more of share buyback. And we always pay a dividend, but obviously in relation of the quantum of the share buyback. So maybe that's the main reason why people like Euronav, because unfortunately the rest of the industry has had a tendency to surprise the market, and I don't think that capital markets like surprises.
Yeah, very, very good point. And talking about your capital allocation, do acquisitions of competitors, do they ever come into your equation?
Yeah, absolutely. As I said, we are reserving 20% of our earnings for fleet renewal. Fleet renewal simply because we are trading vessels, and that's wasting assets. The lifetime of vessel is roughly speaking 20 years. We don't wait until 20 years to trade in or trade out the vessels, so we are relatively active on the S&P from the sales and purchase of vessel. And we feel that the 20% we reserve, and then of course the depreciation, which is the cash that any business would reserve to maintain the business, is enough to not only renew the fleet but also do small acquisition which are slowly or surely growing the business. When it comes to growing the business in what I would call a leapfrog deal, an M&A deal, and we have done one of those relatively big deals every 5 years, which is around the cycle. Then we use the share, we use debt because we are a capital-intensive business and we have very good partners. Mostly banks that are following us, that are trusting us, and so it's a recipe that is enabled to grow the business from roughly 7 or 8 ships when I joined the company 16 years ago to 76 ships today. So it seems that this capital allocation is appropriate for not only rewarding the investors in capital market, but also to grow the business without putting it in danger. In other words, without taking too much debt every time you do one of those acquisitions.
You mentioned that when it comes to the acquisitions, you would use obviously cash, shares, and debt. And when looking at the valuation of shares, do you look at a particular level that your shares have to trade in relation to NAV before it makes sense to look at issuing shares to maybe do acquisitions?
That's totally correct, and we are very focused on that point. We care about our current shareholders before caring about future shareholders, and let me explain that to you. If a business issues shares to acquire a vessel at, well, obviously net asset value, i.e. taking debt and paying the rest in equity, and is doing that using shares that are trading at a discount, then current shareholders will lose out. The future shareholders or the shareholders that participate to the capital increase may be fine, but that's a small portion of your shareholders in total. So we have always paid attention, and we have never issued one single share that didn't create instant value for our shareholders, namely trading at or above NAV. If I can give you an example, the last deal that we did in 2017 and 18 was a merger with a company called Generate. And at that time, we use our share to exchange our shares against their shares because they were also a publicly traded company. And that was done at a premium of 15%. So you can see that we paid a lot of attention to where the share price was trading, but also the exchange ratio, because from time to time you can issue share at a discount as long as what you're buying is even more discounted.
So what you're saying, if the company you are acquiring, if it's, let's say it's trading at 60% of NAV, and Euronav is trading at 80 or 85% of NAV, it would still create value if you issued shares for that kind of acquisition.
Well, the opposite, I would say. If we are trading at a discount of 20% and we are acquiring a business that is trading at a discount of 50%, then it makes sense for us. Okay. If we are trading at a bigger discount than the business we are acquiring, then it doesn't make sense. But I would not spend too much time there because usually that doesn't happen. And it certainly never happens at Euronav. But I was just saying that if that opportunity would present itself, obviously that would be an opportunity we would grab because it would create value for current shareholders.
Okay, all right. Thank you very much. That makes sense. Okay, now let's go back to how things in this market evolved this year. Before COVID and during COVID, when this COVID situation happened, there was a lot of talk about floating storage and the rates being high, and now obviously it's completely different. Can you kind of like summarize like what happened during this year and where we are right now in the market?
Yeah, we are in September, and we have the feeling that what happened this year could have happened over 3 years and not 1 year. So there's a lot of things that have happened. We entered the year with a relatively high level of expectations in terms of the markets because there was a new regulation called IMO 2020. There was a change of fuel, and the fundamentals of the business, coupled with that change, were very strong. And we were looking to have a positive cycle of 2, 3, or 4 years. And the industry in general was very happy about it. Then, unfortunately, we heard the news that of the coronavirus outbreak in China. And I think that, like every single business, things started to look a little bit more worried. People anticipated that the world would not consume as much oil or as much energy as the period pre-crisis. And our rates almost instantly fell from a very high and healthy levels of more than $100,000 a day to $20,000 a day. But that was a very short period in February where the rates were not very high. And very quickly, we moved into another geopolitical event that affected us, namely the oil war or oil price war between OPEC plus members, between the Saudis and the Russians, as they couldn't come to an agreement to cut in anticipation of the lower demand for oil due to the coronavirus. So that instantly created a lot of tensions. Our markets react very often positively for tensions, and those tensions developed into a huge discrepancy between the amount of oil that was produced on a daily basis, and we were at that time around 100 million barrels of oil produced on the daily basis, versus a demand that completely collapsed and lost more than 30 million barrels of demand. What happened next is all that oil that was not consumed needed to find a place to be stored, and relatively quickly the land storage started to say that they were getting full, and obviously once they are full, because they're cheaper than the ship, then people look at ships and store the oil on board the ships. This is typically done in various phases. The first phase is done by the traders, because the traders would put the oil on the ship, but on top of that cover themselves 6 months down the road, and that is what we call the contango, so the difference in price in oil between the present and the future, and usually 6 months, and would play that trade, putting 1 or 2 million barrels of oil on board of VLCCs and Suezmax. That took away a number of ships out of the regular trading fleet, so it squeezed the supply side, and therefore the spot market for the transportation shot up to more than $100,000 a day. It was very volatile, but it remained at very high levels. People then started to think about what will happen after that period of time, but also in between. And what we saw in between is that the OPEC plus countries got their acts together and said, well, this is not sustainable, so we need to cut. There was an agreement to cut 9.7 million barrels, and then some voluntary further cuts done by countries outside the OPEC or OPEC plus organization. And so in total, we believe that the world cut around 15 to 16 million barrels at that moment. The Asian countries got somewhat out of the crisis, started to kick in their industrial program, incentive program. China in particular had a V-shaped recovery and started recovering on the demand for energy, in particular for oil. So they were very thirsty for oil. This meant that our market continued to be good until the beginning of the third quarter. Then we had different events like, sort of second wave of virus in some Asian countries, but particularly in Europe. And then, of course, the first wave in Americas, especially in the US and in Brazil, that has had a huge impact on the economy and on its demand for energy. So you can see that there's a lot of things that have influenced our market. The fourth quarter was very good. The first quarter was very good. The second quarter was exceptional. The third quarter, the first half of the third quarter was good. The second half, where we are sitting now, is, not that good. In fact, we're trading at around $20,000, which is below break even. Overall, the quarter will still be positive, but we anticipate that the remainder of the quarter and the fourth quarter will stay in sort of low territories. Overall, the year would have been exceptional, but obviously the end of the year is not going to be pleasant. And that is due to the fact that the world has not recovered fully from the crisis. In other words, the world is not consuming 100 million barrels of oil again. We need to see what happened. We need to let the world recover, and that is probably after the coronavirus is over. And so there is fewer cargoes to be transported. And at the same time, ships are available to transport those cargoes, and some ships that were doing the storage are coming back to the trading fleet, so adding further to the supply side. And as long as we don't see a strong recovery in the demand, we are likely to remain in an oversupply market when it comes to the number of ships available to provide that service.
That was thank you very much. That was wonderful summary of what happened. You mentioned that some of the ships that were on storing duty, they're coming back and increasing the number of ships available. Do you see any scrapping coming due to the rates being low, and because some of them are just getting old?
Yeah, that's a fundamental question, and it's a very good opportunity to talk about the fundamentals of our business, and certainly the medium-term fundamentals, as we just spoke about the short term. We are in a very luxurious position because we are in an industry that is cyclical. And the reason why it's cyclical is that when there are too many ships, then usually there is scrapping, and when there are not enough ships, usually there is a lot of ordering. And that is the name of the game, the reason why this industry is cyclical. At the moment, we are in a very luxurious position because despite the fact that we have had a number of positive quarters and exceptional quarters, the order book is very low. The order book is around 7 or 8%, depending on which segment you're looking at. And that is the lowest order book we have had in the last 25 years. And at the same time, the age profile of the fleet is evenly spread. And it means that there are 25% of the fleet, which is 15 years or older. And you have to know that at that time you have to pass a survey, which is expensive, every 2.5 years. So when you turn 15 years, you have to pass a survey. 17.5 years, you have to pass a survey. 20 years, you have to pass a survey. And at 20, usually, on average, that's where the life of the ship stops. Because those surveys are very expensive, when the market is low, like it is today, people are reluctant to spend $3-4 million. And on top of that, there's new regulation that forces owners to install a ballast water tank treatment system. And those treatment systems cost $1.5 million. So you have to spend $1.5 million more than a survey that is already expensive. So people are very reluctant to do that when they are not 100% sure that after the dry dock, the ship is going to be delivered in a positive market, in a market where they can make the money and they can recoup their investment. On top of that, and that is maybe a little bit counterintuitive, but people have earned a lot of money recently. As I said, we have had 4 quarters that were very generous. And so it would be stupid to throw bad money after good money. Rather than decide to pull the plug, recycle your ship, and receive money for that. So, in short, to your question, the answer is yes. We anticipate that if the rates continue to stay as low as they are today, we will see a lot of scrapping.
Okay. On the topic of scrapping, because I know a lot of people ask me this question. So, when the ship is older than 15 years, like you said, it has to, during the first 15 years, the survey has to be done every 5 years. After 15 years, it has to be done every 2.5 years. And it gets more and more expensive to complete that survey with age. So if you have, let's say, a VLCC, and you decide, okay, I want to scrap it. At this point right now, how much could an owner of a VLCC get by scrapping a ship?
You would get around $14 million. There are different places where you can scrap your ship, and you can scrap your ships in China, in India, in Pakistan, in Bangladesh. So all those countries will have sort of different tariffs. But I think that 14 million is a good average. We used to get more, but obviously commodity pricing has gone down because of the crisis. We anticipate that commodity prices will go back up when we go out of the crisis, and we hope that that will be at a very same time as people are facing that decision. But nevertheless, with even 12 or 13 million dollars, you're better off than spending 4 or 5 and ending up with a ship that is older than the rest of the fleet, that is not the preferred ship to be traded. So when you put yourself in the shoes of our clients, for instance, when the market is oversupplied, obviously you have choices. Well, they will always go first for a younger ship than an older ship. So not only are you coming back in a market that is soft, where you are not earning a lot of money, but on top of that, your utilization is going down. So on average, you're going to earn maybe only 50% of the time, as opposed to when the market is tight. So all of that means that people are very likely to take the decision to scrap their ship.
Yeah, I think that, yeah, that's very interesting, because when investors look at these things, it's hard for them to put themselves into the shoes of a ship owner. And you're absolutely right. You have a ship, you look at the rates, and the rates are not so good, and you have to spend $4 million plus 1.5 to extend the life of a ship, but at the same time, your ship is not competitive because of its age. So you're going to look really hard at taking that 14 million today.
Absolutely.
Yeah. Okay. So before this COVID situation happened, people were interested in the oil tankers because of the thing that you mentioned, IMO 2020, and also because the industry went through such a terrible long bear market that started in 2009, and then when this COVID came, I think they kind of forgot, and especially now people are kind of losing hope. But do you still see, I don't know if you would use that word super cycle, but do you still see that coming over the next, I don't know, couple years into the future?
Yes, definitely. But before we go into the future, I just would like to say that in 2009, so that was the year after the financial crisis, shipping suffered indeed. 2010 was not a bad year. 11, 12, and 13 were bad years, but then 14, 15, 16 were good years. So I wouldn't say that the shipping has not had its classic cycle. And for the investor, I mean, for instance, if you look at Euronav share price, we hit 16 euro, which is almost double the value that we are today in 15 and early 16. So we have seen the cycle going through also the share price. So I wouldn't say that we have had 10 years of bad markets, certainly not. And at the same time, the company has managed to grow tremendously, and in doing so, created quite a lot of value and distribute dividends to our shareholders. This is a cyclical business, so it's not a business where you can buy today, keep it in your portfolio, and believe that it's going to grow at a CAGR of 5% every year. So that's not the business we are in. This is a cyclical business. There are shorter and longer cycles, and it is true that between 2009 and 2019, we have had short cycles. So 2 or 3 years of good markets, 2 or 3 years or not so good markets, or break even. It is also true that the IMO 2020 was expecting to create a longer term cycle, but that is something that personally, and I think Brian and the rest of management will agree with me, we cannot control, because the better, the longer the cycle, the more chance you have that people order ships, the more chance you have that those ships are delivered at some point in time, and the more chance you have that there will be too many ships compared to the growth in demand. Where do we sit now? I think we sit in a much better position than the scenario that we were contemplating in 2020, because 2020 was about ton miles. We were expecting the ton miles to grow because of further trading or additional trading due to this low sulfur fuel oil that we had to produce, and obviously it was easier to produce it from low sulfur crude oil, which mostly are coming from long ton miles. Today the situation continues to be true because the world needs to produce LSFO. The vast majority of the ships are still using LSFO. We can talk about the scrubber story if you want, but it's not really interesting anymore. And where are we right now? Right now we are low order book, very good age profile for the fleet. So a lot of candidates evenly spread to be scrapped every year. So every year you can expect anywhere between 30 and 50 ships to be scrapped just because of their age. And from time to time, even when the market is good, because when you are 22 and a half years, then obviously you are, even when the market is good, you are scrapping your ship. And so this is a solid foundation for a multi-year cycle. The reason why we are less fearful about an order book growing is simply because nobody knows what to order. We know that we have a mandate to reduce our CO2, and that mandate can only be fulfilled if we change the technology or if we change the fuel that we are using. And gradually we're moving to a zero emission fuel, and certainly during the transition period to fuels that are emitting less greenhouse gases, not only CO2, but greenhouse gases. So today the technology that is available is not yet future-proof. So you may buy something that indeed emits less carbon than the older generation, but you don't know if that ship will be good to trade for the next 20 years. And that's the main reason why people are not buying ships or ordering ships. They're waiting for the market to be developed and to make sure that whatever they're buying is going to be an asset that they can trade for the full lifetime of the ship. And we don't see that happening anytime soon. We believe that technologies are still being developed as we speak, and they are unlikely to be ready before the next 2 or 3 years. So we don't believe that the order book will grow significantly during that period of time, and therefore we should enjoy good markets because of that.
Hugo, I think this was a very nice summary and bullet points of while we can look at all these variables, at the end of the day, this is where we stand, and you provided these nice bullet points of why some people, should have a positive view of what's going to happen to this space over the next few years. I don't have any more questions for you, Hugo. Is there anything else that I didn't ask you that you might want to address before we end this?
Maybe if you give me that opportunity, I think that I always like to say that the capital markets are changing. They're changing very rapidly, and there is a big focus from the investor part on ESG, and in particular on the E and the emissions. And I think that from time to time people forget that shipping is an excellent student in the classroom. We have reduced our emission tremendously in the last 15 years already. As an industry, we have agreed to reduce and to meet the Paris Agreement, so to reduce the emissions by 40% between now and 2030, and that is absolutely achievable. And then obviously by 2050, we also agreed to reduce up to 70 or even 80% our emissions. So when people are investing and starting to have those ESG criteria, I would highly recommend to not judge the industry, but go company by company and see that first of all, the industry is doing good, unlike its reputation. And then some companies are doing extremely good when it comes to ESG criteria. And I'm proud to say that, or I hope that we can say that about Euronav, but I believe we can.
Okay, well, thank you very much for your time, Hugo. I really appreciate this. I hope maybe in the future we can do it again.
Certainly. Well, thank you very much for the opportunity.